All right, we're going to get going here today, everybody. Thanks so much for being with us. We're certainly very appreciative of everyone's time. And if you're joining us today, I assume that you're interested in the world of startup finance. And if so, then you're certainly in the right place. So before we get going, we kind of set the table for some discussions on the capital raising landscape for startup companies and the options available to them. A couple quick housekeeping items. We wanted to make sure that everyone was able to hear us, so just make sure if you could provide us a quick confirmation that you're able to hear us out there, that would be great. And secondly, if you have any questions during the conversation today, we would love for you to enter your questions in the questions chat box. And at the end of the day, we'll be doing a questions and answer session, so we'll be sure to get to all the topics that you might want to delve deeper into, or something that we didn't cover. We'll certainly be able to provide you with some insight there. So again, just encourage you to ask questions, and we'll do our very best to get to them. So today's topic, despite some slowdowns, the seed and venture markets are still relatively healthy. However, capital raising remains one of the most challenging jobs that a startup CEO will undertake. What's your fundraising strategy for 2017 and beyond? How do you plan to raise your next round, especially in a tighter VC market? Today, we will be joined by two startup fundraising veterans as they provide a thorough overview of their respective views of startup finance. Amongst other things, we will discuss the recent funding trends and the rise of alternative funding options, and how to think about your capital stack. So, simply put, today we will, in other terms, we could say we're going to cover what to raise, how to raise it, and tips on optimizing your capital raise. So today we have two veterans, first which is BJ Lackland. BJ is the CEO of Ladder Capital and has spent his career working with emerging technology companies as both an operating executive and an investor. Before joining Ladder Capital, he was a consultant to early-stage technology companies, an angel investor with Element 8, and the CFO of Power Efficiency Corporation. Earlier in his career, BJ spent 5 years as the VP of Director of Summit Energy Ventures, a VC focused on investments in energy technologies. And also joining BJ, we have Nathan Beckord. Nathan is the CEO of FounderSuite and VentureArchetypes.com. FounderSuite is streamlining painful tasks like capital raising and investor relations so that founders can focus on product and customer acquisition. To date, Nathan has helped entrepreneurs raise more than $250 million and has worked with hundreds of startup clients in the last decade. So, without further preamble, we would love to jump in and discuss a look at your capital stack. BJ, help us out here.
Yeah, this is BJ. I will be walking everybody through sort of the mundane aspects of the different securities that you can offer up to different kinds of investors to raise money. And as Tom mentioned, then we'll get into the stuff that I think is frankly much more exciting, and Nathan does a great job presenting of how you actually go about raising this money and such. But first, to walk you through what are the different options out there. And essentially what you see on this slide is a ranking of your capital stack. From the very top, which is the most conservative capital providers, they're also the cheapest for you, and in some ways the hardest to get for a startup, all the way down to the very bottom of the capital stack where it's the most at risk and the highest cost types of capital. Basically, you're going from secured debt at the top to equity at the bottom. So I'm walking through some of these different possibilities. First one we're going to look at is debt. So for a lot of startups out there, senior debt from a bank tends to come from a couple different sort of tech banking sources. Silicon Valley Bank and Square One are two of the best known. You often get also Wells Fargo plays a little bit in this space, as well as Comerica and some others like Bridge Bank. Typically, you're looking at relatively low cost of capital, like I said, somewhere in the 8% range. Sometimes they'll take a personal guarantee, meaning you're actually going to guarantee their money with your personal assets, like your home. And sometimes they'll take a warrant or something like that, depending upon the funding. The other kinds of debt, they're down below here a little more risky and a little higher cost, are things like mezzanine or venture debt. Venture debt tends to follow an equity investor. So it's often hard to get true venture debt unless you've got a VC that's invested in the company already. This typically doesn't come with a personal guarantee. They're really betting on the company and such. And typically they're looking for somewhere in the 15 to 30% return all in between the loan they're going to give you and a warrant they're going to ask for. On the right-hand side here, you've got sort of alternative options. Revenue-based financing is what we at Ladder Capital do. The difference between the sort of the right and the left-hand side here is on the right-hand side where we are, we tend to fund companies that don't have any venture investment. About 45% of the companies we fund are bootstrapped, 50% are backed by angels, and only about 5% have raised VC money. Our cost of capital is about the same as the venture debt type of folks. 15 to 30% is typically what we're targeting. And we also don't ask for a personal guarantee. So you basically, on the right and the left here, the really big difference is to get the money on the left-hand side, the venture debt, typically you need to have a VC already invested in the company, whereas on the right-hand side, you don't. All right, down to the world of equity. Equity, I realize I'm talking about, and then the very first thing you see in the upper left side is convertible debt. And you're like, well, I thought we were talking about equity. Well, convertible debt has become a really, really common structure for, in particular, angel investors to invest in startups. It's really intended to be an equity investment. They want it to convert from debt into equity, thus it's called convertible debt. But legally and technically, it's actually a debt instrument. So in some ways, it's sort of straddling these two different slides here. Convertible debt, because it really is intended to be an equity investment, really those early stage investors are looking for 10 to 20x returns on their money. I mean, it's equity and it's high risk early stage equity money. But that's really become the sort of structure of the day for angels and such to invest before you get a VC in. When you get a VC that comes in and invests in the company, they're going to go with preferred stock, which is in the upper right-hand quadrant here. And the preferred stock is senior to common stock. Common stock is like your everyday kind of stock. Preferred stock is preferred to it. It gets paid off first in a liquidity event. Also, it can come with a lot of kind of bells and whistles and provisions, rights to a board seat, all kinds of things. And that's one of the reasons why VCs use it, is because, number one, they get what's called a liquidation preference. They get paid off first before the common stock, like the founders and such, as well as the fact they can drive a lot of different controls over the business and things like that, called protective provisions. And really, if you're going through an issuance of preferred stock, and almost all of these, you really want to use a good lawyer. I think in particular, a VC type investment can be the most sort of confusing and have a lot of terms you don't really see in normal like loans and things like that. At the very bottom of this slide is common stock, your run-of-the-mill normal stuff, and that's really what you founders out there are going to own. If you have employees also that have stock options, those stock options can be converted into common stock. So effectively, they kind of puts your employees kind of alongside with you in a lot of ways. But common stock is really the very lowest part of the capital stack. It is the most at risk. Also, since you're a founder and hopefully you're getting in early and such, you have the most to gain and most upside possibility. So now that we've got sort of 6 major different forms of capital and such, the key, of course, for entrepreneurs is really putting it all together and figuring out, okay, what different pieces are you going to use when? And what we have here is kind of 3 different paths. This is going from sort of the bottom of the slide up. And these 3 different paths, on the left, we start with the kind of stereotypical VC-backed path. If you spend a lot of time reading TechCrunch and VentureBeat and GeekWire and things like that, you hear a lot about companies going on and raising rounds of venture money and round after round after round. I think the latest one is Uber is on like round N or something crazy. Really, that's sort of a stereotypical path, but it's actually not the most common path. Depending upon the studies you read, anywhere from about 1 to 3% of startups actually raise venture capital. So let's start at the bottom here, really. First is sort of bootstrapping, right? Typically what you see with entrepreneurs, especially today, especially in the software space, is they're going to go and try and get a minimum viable product, an MVP, prepared sort of, by not taking a salary and working hard and such. Maybe they'll take in a little bit of money from friends and family. Then an increasing number of companies are going through incubator programs. That can be everything from like Y Combinator or Techstars to more local programs in other cities and such. And sometimes at this stage they'll also raise angel money. That's relatively universal for all these paths, and that's why we have it across all 3 of them. The next stage is really where the paths diverge a little bit more. On the left-hand side, like I said, you've got sort of the Series A and Series B and Series C going on. You got some opportunities in there for maybe some corporate venture investments. That means an investment from a strategic partner, maybe like a company that's a large customer of yours, or a company that might be interested in acquiring you in the future, or something like that. Also, you can get the tech banks like Silicon Valley Bank and Square One and Bridge Bank to come in and give you money, or venture debt providers at that point, because you've raised a Series A. We then are increasingly seeing companies in kind of the middle path here, where they're taking money like our money, they haven't raised VC, revenue-based financing, and they're really going the non-VC, no dilutive path. A lot of entrepreneurs just keeping their equity. So maybe they're issuing some equity in the early days to family and friends and angels or an incubator, but after that they're keeping their equity and they're just trying to be capital efficient. Once they get over about 5 to 8 million in revenue, you can start to get money from the tech banks then on your own, and kind of graduate from earlier stage non-dilutive funding like revenue-based financing up to tech banks and the cheaper money. Then the third here on the far right is really kind of it's a blended path, putting it all together into a series of things, really, where you can try and optimize, have a lot of capital, like go out and raise that venture money, those big 7 or 8 or 9-figure rounds of financing, but really optimize so that you minimize the dilution to you, the founders. So with this, we see a lot of companies doing this path as well. I'd say at Lighter Capital, about 75% of the companies we fund kind of go that middle route, the non-VC, and then about 25% go on and raise VC. But they'll take our money and they'll get to a further stage, get a better valuation out of the Series A investors from a VC, and then they'll go on and be sort of on the VC funded path and can utilize the tech banks and venture debt and such from there on out. So this is really our attempt, like I said, to sort of put it together, what different kinds of securities you're going to bring into you're going to offer, what kind of money you're going to bring into your business as you grow through its life cycle from the very, very beginning all the way up through like deeply established and going global. With that, I'll turn it, last slide. So the key questions to ask yourself on which one of these paths you're going to take. And really, one of the key things about raising money is kind of know your goals before you go out and raise money. Raising money is one of the things that you do in building a business that's really hard to reverse. If you want to go after a certain market and reverse, that's kind of painful. If you go out and get a certain investor, especially an equity investor, and then you want to reverse that out, that's really painful. So you want to be really careful in raising money and making decisions that leave you open as many options as possible. So here's some of the key questions, really. Equity, like what's the valuation? What are you giving up? Especially in terms of control, the next thing here, right? With preferred stock from VCs, you're effectively giving up a lot of control even if you're not selling a majority of the business, because that's really how they work with preferred stock. Then, is the capital provider bringing you something besides just money? Sometimes all you want is money and you don't need any other cooks in the kitchen. Other times you really want some deep connections into an industry you're trying to break into, or help with recruiting or other things that a VC or other capital providers can help with. Obviously, risk tolerance, if you're putting a personal guarantee on anything, that gets obviously kind of dangerous for your own assets and things like that. Time to raise money. Raising money, as Nathan will really go through in much more detail and great stories and such, can take an incredible amount of time, and he and I talked, and both of us have spent an incredible amount of our careers raising money. It can take an incredible amount of time, and it can take an incredible amount of energy and toll on your enthusiasm. So you really want to think about like how long are you willing to go spend raising money. It takes time away from your business, from building your business, and so you really got to choose which way you're going to focus your time and prioritize. And then horizon and culture, those are really more broadly goals, right? What kind of a business do you want to build? Do you want to build it and flip it out and sell it? Do you want to build it and hold it and run it forever like a family-operated business? That's really going to drive a lot of the different capital that's appropriate for you to raise. With that, I'll turn it over to Nathan for the fun part. I love his presentation.
All right, thank you, BJ. Nathan, take it away.
All right. So just a quick side comment before I jump into my part. I love BJ's presentation because he lays out a really nice, something that's fairly complex or that can be pretty confusing in a really nice way. And it's really important that founders understand your capital stack and the choices you make when you raise different types of funding. because it's always hard to unwind anything, right? If you raise a lot of rounds, I know many founders who went down the pure VC path, raised multiple rounds, had a successful exit, but they owned 2 or 3% of the business by the end after raising multiple rounds, right? And same thing with control. I mean, so there's the dilution, and of course there's the control. You know, we raised a seed round. I now have a board of directors. I still have 60-some% of the company, and I still control the board. But one more round of venture, and I'll probably, you know, have to lose control. So control and dilution and all the other issues that go on there are really important to understand. So I think we're going to be sending this thing out. So, you know, go back and study BJ's section 2 or 3 times so you thoroughly understand trade-offs between debt, equity, and all the various flavors in between. So anyway, so I'm going to talk about how to raise money. So we've decided we're going to raise money. Hopefully we haven't scared you off, but now it's how to do it. And this is how I always like to start it off, is how not to do it. Hunter Walk is a VC here in San Francisco. He's got a seed fund. And I love this tweet from a little while back. Will you introduce me to investors is too broad to be acted upon. However, this is how a lot of startup founders just go about the process. They're like, all right, it's time to go raise some money. They just start asking everyone they know, can you connect me to some VCs? And it's not only too broad to be acted upon, it's putting the work of figuring out who you should be talking to on the shoulders of the other person, when really that's your job. So we're going to cover kind of your job as CEO and fundraising. Next slide. So instead of going about it like that, I like to take a page out of the B2B sales book. And if you've ever been in B2B sales, it follows a pretty structured step-by-step process, right? You build a list of targets, build a list of leads, you qualify those leads, make sure everyone on your list is relevant, can, you know, afford you, and everything else a good fit for what you're selling. Then you engage with those leads, move them through your sales process, and fundraising really is the sales process. And ultimately, you're trying to drive all those leads to either a yes or a no. You're trying to close. So let's go into that a little more detail. And before I get into this, I find that thinking about it as a sales process, and if we can break it into these step-by-step, really takes a lot of the confusion, frustration, and sometimes the anxiety out of fundraising, especially for first-time founders. So step number 1 is building our funnel. You know, 2 key points here. It really is a numbers game, especially at the seed round or angel round. You need to be talking to a lot of investors. When I raised our seed round, I pitched over 200 investors and ended up with 1 seed venture fund and 10 angels on our cap table. And so you can do the math. That was about a 5% conversion rate. That also means I was getting rejected 95% of the time I was out there pitching. And I think that's actually pretty typical. Sometimes that's a shock for founders who haven't done this before, how much you get rejected. Rejection is the norm. That 5%, you know, yes rate is actually the exception. And you have to understand, you know, especially like seed venture funds might be doing 10 or 12 deals a year, but they're looking at 1,000 or 2,000 companies a year, right? So they're just not doing a lot of deals. And even angels, even prolific angels, are only doing, you know, typically a handful of deals a year. So that's just the context that you're diving into here when you're raising money. All right, next slide. So actually, and a couple sources to build your funnel, which we didn't go into. I'll just rattle off quickly. AngelList, very useful. I think there's about 24,000 angels on there. Founder Suite, we built a database of about 50,000 investors and tagged them by market and location. Crunchbase, very useful. You can go in and plug in, you know, similar companies that aren't directly competitive, see who funded them at your stage. And then there's a lot of other databases and sources out there, a lot of daily newsletters for that. I think we'll have our contact information at the end. I can send you some other ways to build your funnel. But once we've built that list of, say, 150 to 200 names, we actually want to be like a good salesperson and qualify that list, making sure that everyone on our list is someone we really want to pursue. right? Good salespeople don't just chase every lead in the door. They prioritize them. They qualify them. They rank them, so they're spending their time effectively. And this is really important for fundraising because, A, you don't want to end up with a bunch of, bad actors on your cap table that will make your life hell. But also, oh no, not yet. Go back. You don't want to end up with a bunch of people you don't like on your cap table. That's awful. But you also don't want to be spending your time chasing and pitching people who aren't a good fit for you. So much of fundraising is about getting momentum going around your round. And if you're driving, an hour and a half each way to go pitch someone who is the wrong stage, wrong sector, just not a good fit for you, you're never going to get momentum going around your round. So just very quickly here, some of the reasons we want to cross people off that list. If they've invested in a competitor, that should be pretty obvious. You don't want to even talk to them. If they're ethical, they won't, talk to you. If they're unethical, they might even send your materials to a competitor. If they're a venture fund and they have not raised a new fund, point number 2 here, they have not raised a new fund in the last 2 or 3 years, they're probably only doing follow-on deals on their existing companies, so you might deprioritize them. There's actually a kind of a large number of quote-unquote zombie funds that have not been able to raise a new fund, or maybe they're currently raising a new fund. They'll take meetings with you all day long, but most of the time it's a waste of time. Same with angels, point number 3 here. If you're looking at angels and you go look them up on Angel List and all their deals are from 2014, 2015, they might be taking a break, might deprioritize them. Wrong sector, stage, and geographic location should be pretty obvious. If you're a, life science company, you wouldn't be pitching a fintech investor. If you're at the seed stage, you wouldn't be pitching a growth capital fund. You wouldn't typically be pitching a very large fund because they want to be writing bigger checks. And, a lot of funds are very geographically specific. Like I was looking, when we were looking at our last round, I was looking at a couple funds, and I'd see, like Voyager Capital, I think BJ had on one of his slides. They're up in Seattle. They tend to do Pacific Northwest companies, not Bay Area companies. And then finally, bad reputation. As I mentioned earlier, you don't want to have, you're entering a very long-term sales contract. Unlike traditional sales where you can potentially get rid of your customers, you're entering a 5 to 7 year, relationship with investors. So to the extent you can kind of reference check people that you're going down the path with, also look them up on thefunded.com or, check with people who have they've written checks to in the past. You want to be doing that check. So long story short, you want to be crossing off maybe 20 to 30% of the people on our list here, and that will help you generate momentum as we get into the funding hunt. All right, next slide. Everyone remaining on our list that we've qualified, now we want to map our connection path. LinkedIn is the core tool here. Spend a lot of time on LinkedIn. I don't use a paid premium plan on LinkedIn. I just use regular free LinkedIn. But basically what you do is you plug in your target investor. In this case, Christoph Jans is the target investor. And you see if you have any mutual connections to Christoph. If you do have more than one mutual connection, there's a hierarchy of who you ask for the introduction. Number 1 would be someone who's made Christoph money in the past. Christoph will take that introduction all day long. I had a couple, a fellow father in my kid's preschool group sold his company for a pretty big exit. He made a bunch of intros for me, and everyone he introduced me to responded in microseconds because he had made a lot of people money. Number 2 on the list are people that Christoph has co-invested with in the past. This could be angels that feed him deals. This could be other VCs that he knows. There's a really strong level of trust that they've co-invested in the past. Third on the list are people that Christoph has invested in, current or previous portfolio founders. You think about it, Christoph spent the time to get to know that founder, did the due diligence, the reference checks. There's a level of trust there if Christoph has written a check to someone. Kind of fourth on the list are the professional connectors, the accountants, the biz dev guy at an accounting firm or the biz dev gal at a big law firm like Wilson Sonsini. Those people know all the investors, but they make a ton of intros, so it's a bit of a weaker signal. And then, fifth on the list are maybe the most common are all the people that Christoph met 2 years ago at a conference at Disrupt or something, and they connected on LinkedIn, but they don't really know each other. If you have zero connections to Christoph, what you want to do is, or one workaround is to look at a couple of Christoph's portfolio companies, reach out to the founders, even with a cold email or on social media, and really just kind of treat it like an informational interview. I noticed Christoph, led your deal. I've been following his blog and reading his stuff for ages. I'd love to hear what it's like to have worked with him and work with him. And then if you get a dialogue going with that founder, it's okay to ask for the intro because founders are usually pretty good about helping out other founders. I strongly advise against doing the cold email in this approach because, Christoph is getting 50 to 100 warm introductions a day. So your cold email, kind of makes you look lazy that you weren't willing to network your way into a warm introduction. And also a lot of these investors filter their own deal flow by how people reach them. So your cold email is already kind of a negative signal about you. Okay, next slide, please. So, we're spending a lot of time in LinkedIn, and I also use LinkedIn to build the funnel. I probably should move the slide up to the very first step one, but when we're in LinkedIn, it's pretty easy to use. You go into the search bar and you put in something like angel investor, hit search, and then, you filter the results by first or second degree connections. First degree are obviously people you've met because you're connected to them. Second degree are people that you should theoretically be able to reach because you have a mutual connection in between. And so I like to do, angel investors, second degree connection, and then pick a location. And everyone that results has their name, angel investor, in the profile. We have someone in common that I can ask for the introduction. And then I'll go through and open up their LinkedIn profile pages, do a little more qualifying, and then, put them to my funnel. All right, next slide. So we're taking a page out of the sales playbook. Just as in sales, you need a CRM system. You need some way of tracking everyone you're going to be talking to. If you followed along so far, you probably have 150 names on your target list that we're going to be asking our connections for the introductions to. Every time you get an introduction, every time you have a meeting, and especially as you go further down the funnel into due diligence, there's going to be a ton of tasks, action items that you need to follow up on. Like a myriad of things. Every pitch meeting leads to like 2 or 3 action items. And so you need some way of tracking this. And just, again, borrowing a page from the sales playbook, there's a reason Salesforce has this gleaming new skyscraper dominating San Francisco's landscape because CRMs are really effective for this. So Google spreadsheets are very useful. I used to build these for clients. They get kind of bloated and messy pretty quickly. Where are we at? Let's see, next slide. We have a system, this is my short little product placement, but we have a system in Founder Suite that is a visual Kanban board style. But whether you use our CRM tool or a spreadsheet, or you're already a Salesforce master, you absolutely need some way of managing all the activities that happen around fundraising, or you'll go crazy. And even worse, things will start to slip through the cracks. I've been involved in startups when I used to consult to startups where we would be running a fundraise and it was like a messy process. And it's impossible to get momentum going around your round if you're running a sloppy process. I know that sounds, like, oh, I would never run a sloppy process. Well, it's really easy to run a sloppy process if you don't have a way to keep track of everything. Okay, next slide. So now we're ready to actually engage. This is where the fun starts. We're ready to rock and roll. So This is an example of an email I used to ask my connectors. So back up a couple steps. We asked we mapped out our connections to everyone on our target list. And a lot of times when you're doing that research of trying to figure out how to reach these target investors, you will find kind of power connectors in many cases, right? People who know a lot of investors. In this case, Jeff works at NASDAQ. He's a friend of mine. I asked him for a lot of intros. But this is the email I first sent to Jeff saying, hey, do you know any of these people well enough to make a lightweight intro? And then Jeff can go through this list really quickly and just respond, in 5 or 10 minutes or less. Yeah, I know Tom, I know Wesley, I know Clark, I know Noah, I don't know these other people, I know Jessica's not investing right now, blah, blah, blah. So Jeff can very quickly respond to my list of intro requests with yes, no, yes, no, yes, no. Now contrast that to that very first slide I showed you. If I had just gone to Jeff and say, hey, Jeff, can you connect me to some investors? He'd have to think about his entire universe of people he knows, and he'd have to process, like, who would be a good fit for me. And that's just too much work. Jeff is a really busy guy. Instead, I've done that work of figuring out who I want to reach, and then Jeff can just opt in or opt out. Next slide. So for everyone that Jeff said, yeah, I'm willing to make an introduction to, I create a new email thread, and it looks something like this. This isn't gospel, customize this to your own style and flavor. But it goes something like this. Jeff, can you introduce me to target, in the subject line? And then at this point, we actually had 2/3 of our seed round committed, so I put that in the subject line. Your subject line is really important because, again, these guys and gals are getting 100 warm intros a day, so your subject line needs to stand out so they actually open up the email. So raising seed round, I have in this raising a seed round, we have some momentum because we already had a commitment. Then I'm doing the ask. I'm asking for the intro to Jason, kind of the why I'm looking to connect with him. And then I include a link to our deck, which is hosted online. We have our slides up on Founder Suite. People use other programs too, but I like to include a link to the deck versus the actual deck as an attachment. It gives you more control over that deck, right? If you attach a PDF, it's out in the wild, it could end up anywhere. Also, with your deck hosted online, you can always be updating the slides. And so even if Jeff sent this email 2 weeks ago, Jason finally gets around to looking at it now. The slide is, the deck has been improved since then. But not everyone likes to include their deck in this first one. I like to do it because I want Jason to kind of look at what we're doing. If we're not a good fit, if we're too early or just not the right focus, he can opt out here. So I kind of use this as a pre-qualifying approach. But really the key points to this are this email is really short, it's simple, it has a little bit of a teaser to it, right? Because we have some of the round committed. If we didn't have part of our round committed, I would put something else sexy and exciting in there. Maybe it's our metrics or traction or something. And then it's something that Jeff can just simply forward along very quickly to Jason, saying, hey, Jason, do you want to take this intro? Send. And then I'm asking Jeff for 5 or 6 intros. And so I rewrite this, 5 or 6 times, and Jeff can just hit send, send, send for the opt-in approach. So making this really easy for Jeff to do the job. All right, next slide. So a few more kind of hustle tips. We're in the throes of fundraising right now. Doing the intros in parallel. So if you, again, follow along this step by step, we spent the time to map our connections to everyone really before getting into the fundraising outreach phase. And we want to be asking everyone, all our connectors for intros, all around the same time frame. We call this the Blitzkrieg approach. And what we're really trying to do here is get momentum going around our round. Every time you meet with an investor, they'll ask you, so how's the round coming together? That's like the classic question that is their probe to see if your round has momentum. So how's the round coming together? to the extent you can answer something like, we just started fundraising a week ago. We're going on stage at Disrupt later this afternoon. I've got 12 meetings this week and 14 meetings the next week. You're signaling that other people are interested in what you're doing. Other people are interested in this round. And this is really important, kind of tapping into the psychology of fundraising. Every investor out there who's been doing this for more than 2 months has lost out on a competitive deal, meaning more investors were interested in that company than they could allow on the cap table. They've missed out on good deals. So you're trying to kind of tap into this FOMO. It's a really interesting psychology. And the best way to kind of create that fear of missing out is to be having, to get momentum going around your own. We could go on for hours about psychology of fundraising, which has got all kinds of oddities and quirks to it. But anyway, so on our pitch deck, we want to be constantly improving this, refining it. Every time you go out, pitch, have a couple meetings, come back, spend an hour on your deck that night, refining it, working on it, so it just gets better and better over time. And especially if you're hosting your pitch deck online, you're constantly improving it. So that deck that's out there to the other 100 people that you've already talked to is the latest and greatest. We've kind of talked about leveraging VCs off each other. And then finally, this kind of an interesting hack that not a lot of founders do is to send out a regular progress report or update report to everyone in their funnel. This is kind of like one of these lesser known hacks that will set you apart from 99% of the other startups out there chasing the same pool of dollars. If you send a monthly update to everyone in your funnel who's not told you no, you're doing two things. You're showing that you can execute, right? Because every update presumably would have some progress points in it. And you're also showing you can communicate. These investors hate it when they put money into some startup and they never hear from that founder again for the next 9 months until the company's almost out of money. So doing this update keeps you top of mind with all the investors you're talking to and shows you're a good communicator. And just kind of, again, these guys are seeing thousands of deals a year. So when they're getting a regular update from you and seeing progress happening, it sort of sets you apart. All right, next slide. All right, just to close this out here, these two top bullet points, make this like muscle memory. Every time you have a pitch meeting or a Skype call, don't end the call, don't end the pitch meeting until you kind of turn the tables around and ask them, what level of interest they have in the deal, what kind of checks they write, ask what next steps are. If they respond with a next step, like, I'd love to have you come in next week and meet my partner, that's a really strong buying signal. You don't get that in every call. It makes, people could be interested even without a next step, but a next step always is a strong buying signal. And then make them actually chase you a little bit. Turn the tables around. Again, this is a bit of this investor psychology. Something like, hey, I've really enjoyed presenting Founder Suite to you and our vision. I'd love to hear how you work with your portfolio companies, and in particular, I'd love to hear how you would add value to Founder Suite, right? BJ talked about, some investors are value add and they all claim to be value add. Make them pitch you on how they would help you out. And this taps into the psychology again, because again, investors have lost out on deals. So if they feel they need to compete a little bit to get into your deal, that's not a sure thing that you're going to let them into your deal. It can really kind of improve the power dynamics, if you want to call it that. BJ mentioned, the time-consuming nature of fundraising, point number 3 here. Fundraising, so if you have the metrics and if you're ready for debt capital, I think in general that can be a much faster approach. Raising equity capital, seed, angel, VC can be really time-consuming. It can be pretty close to a full-time job for a couple months. Every investor usually takes 3 to 6 meetings before you kind of get a yes or no. If you're still meeting with someone after like a 6th meeting, they're probably a tire kicker. I would kind of deprioritize them. But not only does it take 3 to 6 meetings, it often takes 3 to 6 months. And again, that's pretty close to like a full-time job for 3 to 6 months. If it's going on beyond like 6 months and you're still not getting any real strong commitments or a lead investor, something might be wrong wrong and you need to take a break and reassess. But so much of your work is focused on getting that first lead investor or first term sheet. Once you get a lead investor or a term sheet, you can then take that around to everyone else you're talking to and use it as a catalyst to get them to, come in or out on the deal. You've got leverage once you get that first commitment. Just quickly follow up frequently. You've got to chase these guys and gals a lot of times. I usually have a rule where I'll email someone 2 or 3 times. If I'm still not getting a response, I just move them into actually on my Founder Suite CRM, I have a column called no response. I have a no column, which is like hard no, and then I have a no response column. So I move the ghosts, people who ghost me, into the no response. When someone does say yes, there's this Paul Graham of Y Combinator's handshake deal protocol. You just pitch someone over Skype. They say they're in for $50K. Just write a quick little note after the call saying, great talking to you. Just to confirm you're in for 50. Please respond back in the affirmative. If they do that, if they write that, they complete the loop, you can move them into you're committed. If they don't, they're still just a prospect. And then most importantly, keep your foot on the gas pedal until those wires actually cross into your bank. I've seen so many startups. I worked with over 100 back in the consulting days, and we've got about 1,500 on Founder Suite actively raising money. I see a lot of founders start fundraising. They do the right job. They're doing, putting in the time and effort, and then a month or 2 into it, they realize how brutal it is because they're getting rejected constantly. They're waking up in cold sweats. I used to wake up in cold sweats in the middle of the night, couldn't get back to sleep. It's really taxing on your emotional psychology. And then a month or 2 into it, you start to get pulled back into the business, with product or customer stuff you got to do. And the fundraise loses its momentum. One of your investors drops out, another drops out, and the whole thing collapses. So key point here, if you're going to raise money, just go all the way until those wires cross. You can't quit. There's no quitting until the wires cross. And I think that's all let's see, next slide. I think that's all we got. So just to kind of summarize this entire talk, my key points are, think of your fundraiser as a funnel, build the funnel, run it as a process, right? It'll make your life much easier. It'll get momentum going if you run fundraise as a process. It'll keep things on track. It'll reduce the amount of time it takes to raise money if you really, truly run a process. Be ready, number 2 here, be ready to lean on your network, calling in favors where, from long-lost relatives or your high school football coach, whatever it takes, right? You got to work your network, do it efficiently. Literally, I called in. I think I was pestering BJ for dozens of intros, back when we were raising money. You got to work it, and then run into the numbers game, because it does take a lot of, kissing toads as a bad metaphor, until you find the right mix who are going to be accretive to your business. So that's my summary.
Yeah, and my quick sort of roundup of things. Nathan's is great, and all those things are just so desperately true. My experience. My quick things and sort of ending up with the most ownership at the end of the day, besides running the process like you have to, is see if you can skip a round of equity. It's amazing how much that'll save you. As Nathan mentioned, he knows people, and I certainly know people that have gotten to an exit and they end up owning 2 to 3% of the business. So if you can skip around, it will probably come close to doubling your end ownership sometimes. Be capital efficient, which is the best way a lot of times to skip around of equity. And then just don't limit yourself to VC. It's the one that everybody shoots for and has great mind share, but frankly, most businesses get built with other capital, primarily customers paying you revenue, but also a lot of angel money. There's a lot of different money pockets out there, and you can present a good story and run the numbers game, as Nathan mentioned. You can often raise money from a variety of different sources. It doesn't need to be VC.
Yeah, excellent. Well, thank you both so much for sharing your views on the fundraising landscape for startup companies. It's certainly not the easiest thing to navigate, but hopefully we came away with some clear takeaways from these two startup experts. So before we get out of here today, I was hoping to again, go over some of the questions that some of you had. One of the questions that has come up a few times is, will this deck be shared? And the answer to that is absolutely. So in a follow-up for people who were in attendance today and also people who registered, they can expect to get a recording of this webinar in addition to the slides themselves. So you can certainly go over that. And you have our contact information here. And so just looking through some of the questions, one of which is how does this anything change if you're looking for a bridge loan approach? So I don't know who would, BJ, would any of that be different?
I'm sure Nathan's had to raise bridge loans before in the past too. My quick take is if you can call it anything but a bridge loan, that'd be best, because a bridge loan by its very nature sounds oftentimes kind of desperate. If you can go back to one of your existing investors, a lot of times you go back to existing investors and it can explain a bridge a lot more effectively. Most of the bridge loans I've ever taken in my life have come from existing investors, or when I was like a VC and things like that, giving a bridge loan is something that we did occasionally to a portfolio company. Keep in mind that a bridge loan, technically, and for a lot of investors, is a very specific thing. It is meant to get you from one place to the next, and if you don't get to that next place, you're probably going down. That doesn't sound so good. If, on the other hand, you mean what we hear a lot of and we internally call a boost loan, and that means that you're trying to get from where you are today and you're going to run out of your equity money. Let's say you raised the money before and you're trying to get from where you are now to a major milestone or to the next level of revenue or something like that in the future. And you might be close to viable today, but you want some extra cash to kind of boost yourself along and to get to that next milestone. That's the kind of funding that we do, but we don't do bridge loans. So you can look at debt for sure for that, but if the situation is where you're viable on your own, you just want extra money to go and grow and invest in the business, don't call it a bridge loan would be my first piece of advice.
Excellent.
Yeah,
and
I don't have.
Sorry, Nathan, you want to add something? Sorry.
I don't have too much to add. I think BJ hits on something there with the labeling of the rounds does matter, right? Things like the bridge loan or even like seed extension is its cousin.
Yeah.
So it has attachments to it, which are things like, okay, things didn't really work out as we planned in our pitch deck when we raised that last round, but we still think there's something here, right? There's sort of this, we haven't, there's what do you want to call it? Not stigma exactly, but there's kind of like implications of certain labels. So just be careful how you label it. Yeah.
It's like declaring you're on the bubble of failure almost, or something.
Yeah, kind of.
You're not a clear winner, and you just don't want to put that face forward to investors.
And Nathan, here's a question for you: does it make sense to pitch low likelihood investors to help refine and tune your pitch?
Oh, that's a great question. So yes, I love that question. One of the things I didn't mention in this talk, which sometimes I do, is kind of the first 5 or so pitches, we call them burners. They're like throwaway pitches. Even if you've practiced your pitch a dozen times with friends and family and your attorney and your accountant and others, it just, whenever it hits the light of day and you put it in front of real investors, it takes shape pretty quick. So absolutely. It's kind of the same approach like when you're graduating from college and you have these companies where you really want to go work, but you go do some interviews at some companies you're not so keen on just to get into the flow of things. So I think that's a great approach. I would, maybe just have the first 4 or 5, maybe even less than that, 3 to 4, be people you don't really want. And it's also okay, even if you're not super keen, to have interest from other parties, right? The more interest in your round in general, the better. If you have some of these second-tier or third-tier VCs that are kind of pursuing you, that's still a good thing because that shows there's demand for what you're pitching. Good question.
Yeah, I totally agree. There's an expression I like to say to entrepreneurs is like, I think it's a quote from Mike Tyson, which is like, every fighter has a plan until they get punched in the face. And so, going and giving your pitch deck to your friends and things and whatever else is like you'll make your plan, and then when you actually get in front of investors, you'll get punched in the face. And it's good to go do that before you get in front of the investors you really want, because it'll make you more relaxed. It'll make you refined on your pitch. There'll be amazing things you learn from investors. I mean, one thing is, always take the input, always take the questions, and think about how you can alter your pitch or alter how you're phrasing things or whatever. And you're always going to have to, evaluate, did they really ask a quality question you should take into consideration, or were they just completely out to lunch and didn't get it and you need to blow it off? That's always a hard one to judge too, is sort of judge their feedback. But I totally agree. Do a couple throwaways meetings.
And it's kind of a secondary question to that. So do you treat debt financing similar to equity financing in that regards to the kind of the sales funnel approach that you take? So maybe that's kind of each of you maybe take a stab at that, but how do you approach debt financing differently than equity financing in terms of building a pipeline?
I can start with that, but I think yes, you might as well listen. You want to go out and see what kind of options you have. As Nathan mentioned before, debt financing can often be a little bit faster. Depends on obviously the type of business you are and everything like that. Assuming that you are debt financeable, it can be faster. But then you should still go and check out your options and such. That's just smart business. You probably are not going to, in my experience, going and raising debt, have not had to throw as wide a net, but you still basically running a process. It just may not be nearly as complex and time-consuming and broad as equity, at least in my experience.
BJ, how many lenders should they talk to? It probably varies depending on type of debt, but how many lenders should you talk to if you're pursuing debt financing?
Yeah, I think that as companies go through and figure out who is applicable, if you can get 2 to 3 at least that are a right fit, that would be best, right? I mean, let's say that you haven't raised VC money and you've got $1 million in revenue. If you go to SVB, they're going to tell you no. I wouldn't count that as one, right? I mean, that you're going to the wrong source. So if people are just like, no, we don't fund that, go find ones that are like, yeah, we'd look at this, and probably find at least 2 to 3 of those, I'd say, and so you can at least get a feel for what's really possible. And in my experience, you probably won't find the right fit exactly until you probably talk to 8 to 10. And a lot of debt providers, I mean, kind of like equity providers, but I think debt providers almost are more friendly with each other in certain kinds of ways. Well, they'll say, hey, like SVB, if they see somebody that's not a good fit for them because they're a pre-VC round or something like that, they'll send them over to us, and they'll probably send them to 3 or 4 other folks because they know who funds companies like you. So approach folks and then get focused in on 2 to 3 that are sort of stage and size appropriate.
Excellent. And last question here. So I feel like it's regarding the exit strategy. Now, is it appropriate to mention your exit strategy in a pitch with an angel, or is that likely to get you have your wrists slapped? What should you do and what should you mention with regards to your exit strategy in a pitch with an angel?
Maybe you grab it one, or I can.
Go ahead. I have a few thoughts. I've made a lot of pitch decks that have potential exits and stuff in it, but I've probably made more that don't. I think more than anything, the key thing here really is be prepared to talk about it and have some thoughtful answers ready when someone says, well, geez, who buys this thing? Or something like that, or who do you sell it to? You want to be able to say, hey, I think there are 4 different categories of seller, and you want to make it sound like there are a bunch of possibilities, right? Businesses that only have one possibility, that often is a turnoff for an equity investor. So you want to make sure it sounds like there are a bunch of different possibilities, maybe stick them into different kinds of categories and such. And if you've got particular information on one or whatever, maybe you can add that in, like how it's becoming big, what you're doing is becoming interesting to Google or something like that. You can throw that in. I'd probably, my generic answer would be keep it out of the pitch deck probably, but be ready to talk about it and make a slide so you have it ready. Yeah, I second that. I think I have had slides with exit strategy, but by and large I don't. And know kind of who the potential acquirers are and how you would fit into their roadmap and why you would potentially be interesting to them. But it's kind of interesting. VCs often will tell you they don't want to see an exit strategy because they really want you focused just on building a really big, massive, scalable business, and we'll figure out exit later. Some angels are as diverse as are humans, but some angels are a little bit more kind of risk averse. They want to know they're going to get their capital back. And so sometimes maybe if you're talking to an angel, have an exit strategy slide. It also depends on what you really think your business is going to do. If you plan on swinging for the fences, going large, raising multiple rounds, an exit strategy slide probably isn't so relevant. If you think you're going to raise a seed round and then, exit quickly to Salesforce or Google or something because you're doing something directly in the path of their strategy, maybe it makes sense to have one. I don't know. I tend to not have an exit strategy slide.
Yeah, I think even in my mind, it sounds like maybe for you too. It kind of goes in that category of like, have a slide ready, but don't put it in the main deck. So when somebody asks, you look like you're prepared and thoughtful and have it all taken care of, and you're not fumbling. There are a bunch of things like that, like in-depth things about competitors. There's a bunch of slides that you'll find, you kind of have ready in an appendix, so you're ready to answer those questions. And I think the exit's kind of in that category for me.
Perfect. All right. Well, I think we're approaching the end of our hour here, so I want to say a big thanks to both BJ and Nathan for joining us and providing us with lots of knowledge that they were able to drop on us today, and as well as everyone in attendance. So thank you very much for your time. And if you have any further questions about Lighter Capital and our revenue-based financing model and how it might benefit you in your next capital raise, certainly reach out to us. You have BJ's contact as well as my contact on the website at tmalcolm@lightercapital.com. And if you want to explore Founder Suite and how they can help you explore investor relations and raising capital, check out, you have Nathan's contact as well as foundersuite.com. So thanks again to everyone. Hope you wish you the best on your capital raising adventures. And if you have any further questions, please come check us out. Thank you very much.
Thanks, everyone.
Thanks, guys.